Hey, good morning, everyone. Marty Missouri here. It's Friday, August 16th, 2019. Thought I would pop in yet again and update you on the charts, have a conversation on the short-term market dynamics and technicals that I'm seeing. Again, like the last one, I won't get too deep into the weeds on the fundamentals and the economy and things, and those I will continue, of course, to cover in depth on the written blog, so please stay tuned there. You're looking at a live S&P future charts, and this is today's candle. It's just about a half hour before the open, and this is the daily chart. So if you watch this one, you'll see it move up and down, a little bit as the market ticks along. Um, if you've been following me here of late, you know that my feeling about this downdraft that we've had in here, since July, late July, isn't over. From just a pure technical perspective, this looks a lot like a corrective phase where you have the first wave down, you have a snapback rally and a few back tests, and then which is happening in here, and then you find your way down ultimately to lower levels. But of course, it does not have to work that way. In fact, there's a lot of incentive in the powers that be who can move markets on a very short-term basis to inspire the market higher. So again, we've had this correction. We found a bottom. Now again, this is the S&P futures chart, so it's going to look a little different. For example, on the S&P index daily chart itself, this was a red candle, but these trade virtually around the clock. So you just a little different, an extension of candles and so forth, but of course, virtually the same exact direction and so on. And again, right now, this candle right here is this morning. And we can see we're butting up and back down against this 38.2 retracement. I've made these levels very clear to you here in recent videos as areas that would probably be resisted during the snapback rally. So as you can see, the other day I was talking about the 50% retracement. Clearly, it's the 61.8. All of these three are key. So again, we came down, bottomed right here, came up, meandered around a little bit, just close, just above that retracement level, came down, tested it, failed it, tested it, failed it, closed right below it, which was a fail, and then precipitously fell through here. I did my last video right here when this green candle was getting underway, and I thought going into that morning that we were going to come back down here. I thought that was it. And I thought this snapback rally was probably done. And then we come down below these lows and begin talking about other support levels and so forth. But right after the open, in fact, the market started lower. Right after the open, we got the announcement or the tweet or whatever it was from Washington that said those new tariffs, that where there were going to be no exceptions, there became a bunch of exceptions and delays and so forth. So the market loved that headline and money came rushing back in. And of course, there was a bunch of pessimists in here like me. So there was quite a bit of short interest in here, folks who had sold borrowed shares, probably right up against that line, expecting this thing to fall apart. Certainly made sense technically, and that they'd make a bunch of money. Well, when the move went against them, of course, if you're short a stock and it goes up, you can lose a ton of money. So they'll cover, being responsible. They were wrong. Market goes up, they cover, but that covering is buying stocks, and so that pushes the market up even higher and adds momentum. It's easy to get short covering rallies, but probably push the market further than it would have otherwise gone. Okay, but we did stop. The bears came in and said enough is enough right here and pushed the close right down below this level. Then overnight, the infamous twos, tens yield curve inverted, signal that has preceded every single recession since World War II, is one of our data points in our macro index, and it actually inverted. The 2-year yield went above the 10-year yield, and frankly, that says kind of ominous things about economic prospects for the moment. We can argue what the Fed is doing and other central banks are doing the world over really provides some real distortion. And this could be, the first false signal since World War II. And it may very well be. I'm open to all possibilities. It's just that the market reacted to that. So that was really something more fundamental. Here we have headlines noise. I told you in here that look for the White House to step in and with the president with a tweet. They really don't want to see this market fall apart. But I've been saying, and I'll say it again, well, we may very well rally right out of here. There's some real legs under this rally this morning. This is in Dow terms, this is probably pushing 250, 300 points, about 25 points on the S&P. So this is no small move, and I'll talk about what happened here. So absolutely, we could go through break through these levels. I still think there's a lot of pessimism, a bunch of bears in here who are short and could get trapped and have to cover and push this thing up. Yesterday we were looking again, so we had this look like some follow through, look like this may be the one that takes us down. And quite frankly, folks, I think it's important for this situation that bothers me that the market does come down, because it seems like the worse the market gets, the more anxious the certainly our side of the table is to get this trade war over with. Sooner or later, we're going to continue to beat on the economy and beat on the data. And it's been really mixed this week. There's been some surprisingly good data that I'll probably talk about over the weekend. It'll certainly show up in my index. And it may very well pull it out of the red. I've been in the red for the last 2 weeks. And although housing starts were not good this morning, but housing permits were good, and they each have their own spot in our index. So we'll see. But consumer sentiment is coming out here at 7 o'clock this morning as well. So that's an important indicator. But nonetheless, we're not in recession. And I don't think we will be if the trade war goes away, for one, the trade war with China. I think if that went away and we stopped talking about tariffs, I think this economy and this bull market has a ways to run, quite frankly. But if we don't, and if we don't get there soon, like the yield curve inverted, my index is in the red. And a lot of people are saying, "Oh no, the economy is great." Take my word for it, the economy unequivocally is not great. It's not a recession yet, but it's moving, trending on balance in the wrong direction. I mean, I've said it before, we have a consumer that's in pretty good shape. Like industrial production numbers this week were not good. And and the consumer, the consumer's hanging in there. Retail sales were good. Some manufacturing data was good as well down in here. So there is some noise down in here, but I can see where the trends lie. And then the credit markets are screaming some ominous signals. Credit default swap spreads are getting wider. The high yield credit spread is going higher. That's a bad sign. And then of course the yield curve. So we've got issues in here. So I think the way I'd like to couch this is something's going to have to happen in here. We've got the consumer that continues to do pretty well. We've got, I'm going to call it the industrial complex or the business sector that's not. This is going to have to resolve ultimately, folks, one way or the other. These folks are already stopping expansion plans, very, very concerned about the state of geopolitical affairs. But these folks are still working, and the stock market is still, we're just a few points off of all-time highs. By the way, we're no better than we were well over a year ago. So it's not like we've been having this resounding bull market like so many people seem to think. But the levels are high, and they still have, some decent looking 401k balances, and they feel pretty good about it. If the market rolls over, as it looks like it may, and the consumer rolls over with it, this line right here, let's call that the trade war for now. The consumer can come crashing through here, and then everything can roll over. We can have a recession. You can end the trade war, but if we're down here, I don't think it matters. I think we get our bear market. That's one scenario. Or, things get better, we get better news. We come back here, and the industrial sector, if you will, joins the consumer, and we work our way up, sustainably into more of an expansion and more all-time highs for the next couple of years, would be my best guess. But without that, I think the potential, I'll say it again, for the consumer to crash through this line is very high. All the while, we'll get data points, we'll get news, conflicting like this week. A couple of regional manufacturing surveys were good. Industrial production was bad. Credit markets are waning. That can happen for quite some time before this ultimately pulls these guys down. So that's obviously not the preferred scenario. The preferred scenario would be this. Just doesn't happen. In today's world, when you look at the fact that the US is 4% of the world population, commanding the largest economy, make no mistake, folks, we are a global economy. No ifs, ands, or buts about it. We have taken full advantage of the rest of the world, and it's been a mutually beneficial thing. There are no winners and losers in trade, of course. There's either all winners or all losers. When global trade is up, I have a chart on it. The economy is doing well. When global trade goes down, we end up in a recession. I've shown that on the blog. I'll show it again. So we need to get off this us and them path when it comes to trade. China's doing some things that they need to stop doing, no question about it. But it has nothing to do with the trade deficit and everything to do with intellectual property and so on, things we talked about before. But shooting yourself in the foot, asking your importers and your importers and ultimately your consumers to pay tens of billions of dollars in taxes, and that's what tariffs are. They do not come from China in no way, shape, or form. They come right out of the U.S. economy. That is no way to deal with the real issues like intellectual property theft. And I think the president is learning that. I said in here, watch for the White House to do things, watch for it to, look for tweets and so forth. This right here today, it looks like we're losing it a little bit. But this overnight was all about President Xi agreeing to talk on the phone with President Trump. President Xi was not interested in making the phone call to President Trump. President Trump called him and said, hey, let's talk by phone. And then he said, hey, they really want to do something on fentanyl. So I think the president's looking for a good excuse to dispense with the tariffs that are set to go into effect September 1st and December 15th. It's going to be tough because he did say they're done and they're definite. But if he can unwind those and say that, you know what, they're going to stem fentanyl, no tariff September 1st, kind of like the Mexico situation here a few weeks ago. I think you're going to see a rush of money into this market, and we're going to be testing higher highs. So again, look for, if you're bullish and you think this thing's going to resolve higher, I think a catalyst for that would be an announcement that, hey, I just got off the phone with President Xi and don't need to add those tariffs. They're going to compensate this way. They're going to buy some soybeans or what have you. That's what it would take to get a nice, big, sharp rally. If they get off the phone, and because China's playing hardball now, no doubt about it. President Xi may have just agreed to have a telephone conversation so he can tell him, until you do this, this, and this, we're not buying a single soybean. And the other thing I just forgot to mention was that the president's announcement that we're going to talk on the phone came right after an announcement from China that said we are preparing our retaliation for these new tariffs that came out of the blue. So I think that got the president's attention as well. So I do think, folks, if you look at the news and you look at the commentary, it is a different dynamic. It is a different ball game. I do think China probably has the ball right now, and it does look like the president is on the back foot. But doesn't mean that we can't get rid of this, get the intellectual property protections and so on and so forth. It just means that the president's going to have to give up on something that he really seems to want to keep, and that's tariffs as a weapon. And then when it's all done and we're done with China, you cannot exploit what I'm talking to the president, what you told the Commerce Department to give you, and that's a study that says, Mercedes-Benz coming into the U.S. are a national security risk, so you can throw a 25% tariff on them. Can't go there, or the market's going to come crashing down. Cannot continue to say that Vietnam is the worst one in the world right now, and they're taking full advantage of us. Not when you slap tariffs on China. Had a lot of companies, U.S. and otherwise, who export from China or used to the U.S., uproot those supply chains, pay them millions of dollars to do that, move over to Vietnam, and just have them send that out of there. You just move the trade deficit from China to Vietnam. It has a bunch of dollars with which to buy the treasuries every week and buy our stock market and so forth. So it's not bad to have a trade deficit with an emerging nation. What's bad is to tariff the producers who give us really cheap prices when they do their labor over there. Imagine being the producer who had to leave China thinking you went over to Vietnam so you can continue to do your business with the U.S. because your buyers are substituting, from other places. Now they can buy from you again. And then the powers that be threaten a 25% tariff from Vietnam. Can't go there, folks. India, second largest population, or if they're not even a tie with China. That's a population we want to be very cozy with. At least our companies do. I guarantee you. We need to stop threatening tariffs the world over and deal with issues that us and our Western allies complain about, like intellectual property theft from China. Deal with those on a coalition basis. There are methods. I've offered up solutions here on the blog, and abandon the tariffs. And Mr. President, you're going to look really, really good come election time because right now you still have time to reverse this tide and get back on track. You just need to get back to 2016, 2017 when you weren't publicly talking about tariffs and you were talking about, back then it was tax cuts and infrastructure. Now it's easy if you just quit talking about trade wars and tariffs. But we'll see. There doesn't seem to be the political will to stop it at this point. My concern is, and this is what I'm seeing in my analysis, is the longer that happens, the more deterioration we get and the more chances of a recession creeping up on us. That begins, and then you can end trade wars. And once we're in recession, we're just in recession. You'll get these huge market bounces on news, but you will end up with a bear market and so forth. Okay, so just to kind of close this out again, I'm looking at, here's our decline. Repeat my arrows. You tend to come back, you establish resistance, you fight with that for a while, then you go down, you break down through these other levels. Let me show you how that looks. And it generally happens over and over and over again. Here, just in recent history. Here's your May, we came down, pretty nice dip, came back, here we go. Came back, hit what this case was a 50% retracement level, bounced against it, bounced against it. Look familiar? Bounced against it, bounced against it, came up. Didn't quite have another test like we did the other day. Fell apart, came up, had a nice rally, and then finally bottomed down in here. So wave down, snapback rally, wave down, bottom. I think ultimately this one probably goes down and we can gets down below here. Unless some of these things resolve themselves and I'm talking about soon. I just don't think even these levels hold up. I really think we have further down to go. At least that's what the charts are screaming at me. Go a little further out. And the biggie this last year, on an intraday basis, this was a 20% correction. Here your first phase down, snapback rally, again, if I zoomed in on that, it looks a lot like what we're dealing with right now. Test came down, big green candle, big red candle, finally gave up the ghost and then bottomed here, came back up, right? Topped, played with it for a little bit, gave up the ghost. I actually thought, in fact, technically, I thought this was it right here. I thought we were going to go higher. I was talking about that here on the video. But then we had some things go on. Basically, I'm a tariff man. We got that about right there. Arrested the Huawei CFO in Canada, and then the bottom fell out in December. I think this sort of scenario is very much in the cards because of the data is so much weaker now than it was in here. Our index was at 22 down here. And I, quite frankly, you may recall, was very sanguine in here. I said this was volatility to ignore. And then we just came back too quickly. This should have fixed this trade war nonsense right in here, but it didn't. We came back too quickly. Now we're in a tougher position. China isn't nearly as eager to deal here as they were back up in here and down in here. So now it gets harder. And so now I've got data that's a lot of it is rolled over. It's looking recessionary to me. And I'm paying very close attention to the Asian media and everybody else. And things could turn very quickly. But the rhetoric is very negative. Asia's on the offensive. The U.S. is on the back foot, but Trump has made this tariff scenario part of his campaign, and I think he expects to take it right up at least near the election next year. My concern is now if he takes it too far, we end up in recession, then it's too late. That's why we're hedging portfolios with options. So we'll see, folks. We'll see. Right now, I am not feeling the warmth that I was feeling back here. Feels kind of cold and stormy. Could turn into something worse. Doesn't have to. I think we could very well. We could absolutely end today strong on follow up from China. News that maybe we will buy some soybeans or something. Dealing with the latest round of tariffs that have been added, that absolutely could make you feel real confident. That hey, the worst is over. Not the case. not amid what's under the surface and what's calling the deeper fundamental problems. Those things have got to go away before you're going to hear anything bullish from me, and before we're going to even begin to lighten up on the hedging that we're doing on client portfolios. We could easily go back into all-time highs, and you could wonder what the heck I'm doing. Well, I'm dealing with the underlying trends. This is the prevailing bias. Underlying trend, as I illustrated for you earlier, the fundamentals is down. Right now, it doesn't look like the prevailing bias by itself can pull up the underlying trend. I need a fundamental change in geopolitical action to get my underlying trend back up and to get back into bullish mode, which I have been consistently in since the last recession. So this is not me just being the perennial pessimist. If anything, I'm the opposite. This is just me dealing with what I see. Doesn't mean it has to resolve and my fears are going to come to fruition. But if we're managing your money, we can't sit here and simply pretend everything's going to be okay when the data is telling us that there's enough of a chance that it's not going to be. And if we roll over and all that triple B debt that I talked about inside of pension accounts and nonprofits gets downgraded all at once, we've got a credit nightmare, and it could be something that reminds us of 2008. So if that kind of risk is under the surface and we've got pressures that are pushing down and maybe going to catalyze something there, we just want to be ready for it. Which means if we use a options collar like we are, we're going to give up some upside to protect against the downside. We're going to do that for the next few months, and then we're going to reassess it and see where we are at that time. Thank you, folks, for enduring that long one. And I'll be back again, of course, very soon. Take care.